As inflation continues to rise in many economies, investors are increasingly turning to inflation-linked bonds to diversify and protect their portfolios. Unlike traditional bonds, which can lose value during inflationary periods, inflation-linked bonds offer interest payments that adjust with inflation. This unique structure enables investors to safeguard their purchasing power as returns rise in line with the Consumer Price Index, CPI, or other inflation indicators. One popular type is the U.S. Treasury Inflation-Protected Securities, TIPS, which adjust the bond's principal value to mirror inflation changes, thereby increasing interest payments and the final payout. Inflation-linked bonds from other countries follow a similar structure, providing a reliable inflation hedge across global markets. Another important example is that of the World Bank, as it has been issuing inflation-linked bonds since 1985 and has become one of the largest and most active issuers of these instruments in the global market. The UK government is one of the pioneers of inflation-linked bonds, having issued its first indexed gilt in 1981. With various maturities ranging from 5 to 50 years, and it has become one of the largest and most liquid markets for these instruments in the world. These bonds are especially beneficial in times of economic uncertainty, when traditional fixed-income assets face declining real returns. Countries such as the United States, India, Canada, and a wide range of other countries issue inflation-linked bonds. Each country has its own method of calculating these costs on a regular basis. Additionally, each nation has its own agency responsible for issuing inflation-linked bonds. However, investing in inflation-linked bonds is not without challenges. These bonds often yield lower returns than regular bonds during stable economic periods. Depending on the jurisdiction, there may be different rules and requirements for the issuance, pricing, accounting, and taxation of inflation-linked bonds. Therefore, investors must weigh the benefits of inflation protection against potentially lower returns, especially if inflation is expected to stabilize or decline. For portfolio managers, the addition of inflation-linked bonds serves as a strategic hedge against inflation risks while contributing to a diversified and well-rounded portfolio. In summary, we were able to understand how inflation-linked bonds offer essential protection against the loss of purchasing power in times of inflation. Knowing how to effectively use these bonds in a portfolio could be a valuable asset for managing long-term financial health.